Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Hello and welcome. Now, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis, or any related items on these, my own charts. This is all my own original work, as I think you deserve to have that. So with that, Chicago soybeans. Okay, so first a quick look again at my longer term monthly charts, as there is some interesting actions taking place there. So we can see that the action since as far back as the low seen in August last year, till October this year, built a sideways action. I noticed this action 39 weeks ago, and I will expand on that part shortly. But I just wished you to see that this sideways action has had a breach on the upside, and the market is trying to stabilize over this sideways action breach. Originally between about the 2019 today uptrend, which is currently at 979, up to the topside congestion, the 1105.5 area. We seem to have established a basing action around the triple bottom formed over August 24 to August 25. Once again, as I've done for quite a few weeks now, feel obliged to caution you about the possibility of a false break higher. But as even now this seems unlikely, then we have a primary target on this longer term chart up in the 1189 area, with a secondary hard reach target up in the 1244 area. In the way is the bright red neckline, which is currently at 1213.5, and some congestion between 1141 to 1232 from early to middle 2024, and this seems to have affected the market. Back to my daily charts, and you can see that's the same bright red neckline hovering over the market, just underneath the top of the daily chart. Now, in addition to this bright red neckline, 39 weeks ago I highlighted here on my daily chart a bright pink July 24 to October 25 rectangle pattern, which you can still see currently at 979 to 1105.5. This is the outline of that basing pattern I spoke about on my earlier monthly chart. This pattern had worked until late October, when prices punched up through the upper pink trend line, taking most of November to stabilize over it. Now, 3 weeks ago, prompted by the bullish action on the Winnipeg canola the previous week, I drew a dark blue mid-December 24 to early August 25 bullish Andrews pitchfork. What is noteworthy about this pitchfork is the effect the dark blue middle time, which is currently at 1158, had and has on the market since the start of November. It was a cap. A pierced cap, but still a cap, and one that caused the market to develop into perhaps the most interesting short-term pattern here. You see, we have since late October formed a head and shoulders top. Last week I said about this pattern, and I quote, "This is not fully justified, as prices have only yesterday dipped below the bright green neckline, currently 1146.5. Thus I cannot lay out targets below as yet, but I can set out some potentials. Hence, a primary potential will be down in the 1107 zone, just around where the bright pink broken upper trend line lives, whilst a secondary potential, a harder to reach potential, will be down in the 1080 zone. Please note these are just potentials at this time, as we sit with only one close below the bright green neckline, and there is still a significant chance for a false break on the downside." End of quote. Today, a week since, this pattern is fully justified, with the market already reaching the primary potential, now target at 1107, and the secondary hard to reach potential at 1080 becomes target X. There is also something else I spoke about last week which I would like to discuss, and I quote from last week, "One final feature, and this is right now in development. We are set to make up this week a weekly key reversal. Thus, if we close tomorrow night either over 1146 or under 1134, then we would be on. Anything in between will have a lesser outside week pattern. At the moment, we are looking at a weekly key reversal down, which would time with the earlier head and shoulders top pattern. But please remember, we still have Friday to go." End of quote. Well, we have since then formed a weekly key reversal down last week, and that in part is an explanation to the subsequent move lower we saw this week. Now, this week's action started to push lower, but by yesterday, three things had seemingly eroded the immediate bearishness. They are 1. The old pink breached upper base trend line, which is already up there, I mentioned earlier. 2. The 50% Fibonacci of the May to August 24 move at 1098. And 3. The rising green short medium moving average, currently 1090.5. These have eroded the bearishness that possibly, just possibly, we may still see a halt, if only temporarily, in the follow-on lower to this head and shoulders top. If it doesn't, then we have actually little support until the 50% Fibonacci line of the August to date move at 1067.25 and the nearby change gap 1063 to 1070.25. Chicago soybean meal. Okay, so in 2025 so far, we have had a pair of descending wedge patterns, plus a reverse head and shoulders pattern, that have broken on the upside, resulting in a significant move higher, reaching topside targets and becoming something that had been trying to alter the whole strategic basis of this market, a point which I will discuss later on. In the immediate past, the market had peaked up over the significant resistance of the dark blue trendline extension to the July to September 2021 descending triangle pattern, currently 315.5, and started stabilizing over it in late October and early November. It looked initially as if it was possibly forming a base, but then no. Meanwhile, the top side had resistance, as I stated 5 weeks ago, and I quote, 2 others that need to be noted. The first is easy enough. It is the high for 2025 at 326.60. Interestingly, around there we have some other resistances, notably the 50% Fibonacci line for the May 24 to July 25 move at 326.20, plus some congestion at 326.90. So that altogether they make an overhead congestion area between about 326.20 to 326.90. Then above this is the 61.8% absolute Fibonacci line at 336.30. And I will leave it at that. And that's the end of the quote. Up at these levels, we indeed found resistance, though the peak 3 weeks ago was short of testing that 61.8% absolute Fibonacci line. The next question following this was simple, and I asked it 3 weeks ago, and I quote, the next question is simple. Do these resistances form a top or a bullish halfway hesitation? The answer is not obvious yet, though we did have a horn top which failed, and then a higher 2-day bearish tweezer top pattern from which we saw the outcome in a fallback below the interesting 326.20 to 326.90 congestion. End of quote. Well, the question was answered as we formed a late October to early December head and shoulders top. Early last week, prices broke down through the bright red neckline, currently at 320.60, and carried on low until yesterday. Last week I said the following when I quote, thus I've laid out some possible targets below for this pattern, of a primary target X down in the 308.70 zone, and a secondary hard to reach target X1 down in the 299.80 zone, close to the 50% Fibonacci line for the whole of 2025 so far at 298 even, and at the start of the big congestion from April to August 2020. End of quote. Very late last week, the market reached target X, and then yesterday prices reached down to target X1, and we have seemingly started to halt and even consider pulling back up, but not as yet. Not only do we have that congestion mentioned between April and August 2020, but we also have the rising green short medium moving average currently at 302.70 and the 50% Fibonacci line for the whole of 2025 so far at 298. I am now watching carefully to see if this is just a pause before moving lower, or is it the start of a basing action? Finally, this commentary would not be complete without my discussing a portion of my commentary which I have repeated now for 131 weeks, so for 2.5 years. It is the annual key reversal seen here at the end of 2023. I said back then, and I quote, I now only need to remind you once again of my words when I pointed out the Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023 and been living in the shadow of this pattern ever since. End of quote. I've also added ever since, and I quote, if there was only one thing you take away from any of my musings, let it have been those words. End of quote. For 2.5 years, the shadow of that pattern has darkened the skyline of this market. During October, it looked like we might be seeing the first signs of the light of dawn stretching through the darkness. I'm sorry if I sound vaguely poetical, but this bearish longer term pattern has been such a cornerstone and companion to this market for so long, it's hard to imagine a time when it may end. But end it must. However, this construction of a head and shoulders top pattern, well, it looks like it is delayed. Chicago soybean oil. 4 weeks ago I said, and I quote, "With all the activity in the soybean complex, it was time I finessed this daily chart to show a better and clearer view of what is going on." Thus, the key pattern here is the newly expanded, sorry for the pun, the newly expanded dark blue April to date ascending expanding wedge pattern, which is currently 51.89 off the top of my daily chart. And that's the end of the quote. This pattern, specifically the dark blue lower trend line, is, I suppose, acting more as an attractor than an ascending expanding wedge pattern these days. I also added 4 weeks ago about this market, and ever since, and I quote, "What I can say is twofold. Firstly, in the immediate market, please pay attention to the overhead mauve medium moving average, currently 51.42, as this cap price is in October, and also the gold long moving average below, currently at 50.25, which, whilst it is not perfect, has helped bolster the second thing to watch for, and that is both the 50% Fibonacci line overhead at 53.59 of the July 23 to August 24 move, and the 38.2% Fibonacci line below at 48.95 of the significant March 20 to April 22 move. These two features seem to be better at defining the market right now." And that's the end of the quote. These last few factors about the medium and long moving average, well, they sort of still apply. The gold long moving average below does, but 3 weeks ago, and again last week, the market pierced and closed over the mauve medium moving average overhead. They have since headed back down. However, all this action has led me to draw a potential new pattern. A bright red October to date ascending wedge pattern, currently 50.66 to 53.27. And this uses the dark blue lower trend line like the center line of an arrow or a spear. The only issue is that this ascending wedge pattern does not yet have the requisite number of touches, as 5 are needed in total as a minimum of at least 2 on one side. And so far we just have 2 on each side. Though we might look at this week's actions maybe next week and have that third touch on the lower trend line as possibly being a fifth. This pattern then leads me to another possible pattern, a pattern that generated the ascending wedge pattern in the first place. The mid-September to date double bottom. This is not an elegant pattern, but it's still there, and the only issue is that we have not triggered it as yet, with prices down where we are. I said 3 weeks ago about this, and I quote, "The neckline for this pattern is at 52.11, and we have had a close over it, and we swiftly turned lower, so there is no confirmation as yet. However, I feel obliged to lay out not targets but potentials for such a possible move higher should it occur, in between my weekly commentaries. Thus, a primary potential will be up in the 53.59 area, right where the 50% Fibonacci line for the July 23 to August 24 move is, and a secondary harder to reach potential up in the 55.56 area. The primary potential is certainly doable, but only if we can overcome the mauve medium moving average and reach that 50% Fibonacci line." End of quote. Now there's a lot to unpack there, as we most definitely had multiple consecutive closes over 52.11 last week. But, and it is an important but there seems to be a false break. Hence, I would still stay with the potential numbers, but that any break higher needs to be verified, and that it is not a false break. Hence, as I said last week, and I quote, "I would look now to see if we can make consecutive closes over the 53 even area to look to verify it. I know that isn't pretty, but that bright red upper trend line looks like where it will be on the top side." End of quote. I'll now also add to this that we might, just might, be forming a more recent mid-November to date double top pattern, a seeming interim pattern. It all depends on not only multiple consecutive closes below the bright red lower trend line, but also below the gold long moving average and the late November lower 49.78. It's too early to confirm this pattern, but as I said about another pattern here, I can give some potentials. Thus, on confirmed breaks lower, we would have a primary potential down in a 46.56 zone and a secondary hard as a reach potential down in a 44.66 zone. Finally, and I warned about this 3 weeks ago, we've had a monthly key reversal up in November to add yet more fuel to the mix.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.